Thank you, John. With Pete's absence, it is my distinct privilege to be able to welcome David Dietze back to our lectern. David is an old guard member, and he appeared first as a speaker back in 2007. Today will actually be his fourth appearance as our featured speaker. Watch out, Nolan Ash. David is catching up. David was born in Columbus, Ohio, but he ventured to the East Coast for his undergraduate education. He is a magna cum laude Phi Beta Kappa graduate of Dartmouth College. Law school brought him back to the Midwest. He earned his law degree at the University of Chicago, and he has practiced both corporate and finance law with firms in both New York and Washington, D.C. But David's accomplishments extend far beyond the field of law. He is a Chartered Financial Analyst and a certified financial planner. And did I mention that he was an economics major with honors at Dartmouth? In 1993, he founded Point View Wealth Management, an RIA, a registered investment advisor, extremely well thought of in the industry. In 2019, Point View became part of the Peapack-Gladstone Bank. And today, David is the managing principal and senior portfolio strategist at Peapack Wealth Management, the wealth management division of the Peapack-Gladstone Bank. David is uniquely qualified to address today's topic, current market promises and perils. David.
Good morning, all. Delighted to be back here for my fourth time. Special thanks, of course, to Peter Bolton, who's, I guess, the program chair for this month, and Steve Varley with his very kind introduction, and, of course, Paul Tukey, too, for his arrangements. Awesome. Thank you. So, as Steve pointed out, the title, Current Market Promises and Perils, 2023. Okay. Yep. Steve greatly, thankfully covered my background there. And Peapack Private Wealth Management, proud to be part of my new employer after merging my business in with them. You know, what do we do there? In addition to managing assets, provide customized financial planning that includes taxes, retirement planning, intergenerational asset transfers, college financing, estate planning. All part of the services, no extra cost, performed by qualified specialists. You know, for me, it's all about adhering to the highest fiduciary standards. That always means putting the client first. If I've had any modicum of successes, I always think, if I were in the client's shoes, what would I want done? Once I figure that out, the rest is easy. Everything is customized for the particular situation. So, we're going to talk about what to expect in the rest of this year, but sometimes it makes some sense to look back just a little bit, the year just passed. So, you know, last year, at the start of the year, this time last year, we were told inflation is going to be transitory. By the middle of the year, we were clocking in with the worst inflation in 40 years. Interest rates, about a year ago, they were zero. By the end of the year, some rates had nearly quadrupled. Our Federal Reserve, which manages the money supply, made light of inflationary scares at this time last year. But by the end of the year, they had increased interest rates dramatically, 4 3/4 points hikes. 2022, we saw our first bear market, well, since the subprime crisis, although there was technically a bear market during the pandemic. And that means you're down 20% from a recent high. All the major market averages finished last year down for the worst year since 2008. Interestingly, bonds offered no protection, even adding back income. The average bond index was down over 10%. Inflation exacerbated by the surprise invasion of the Ukraine by Russia. China, the world's second largest economy, proved a drag on the economy by trying to treat COVID without Western vaccination, primarily by lockdown. So just taking a look at this a little bit, here's your long-term chart of inflation. You can see on the right, where it spiked. So the question is, what caused that? Supply side snafus due to COVID, reduced the availability of imported goods, and on the labor side caused many workers to drop out of the labor force. Even more importantly, our Federal Reserve, in the name of stabilizing the economy and trying to minimize the fallout from the pandemic, reduced interest rates to zero, spurring borrowing and spending. Our government issued many pandemic checks, which also chased goods and services, driving up prices. Interest rates soared relative to where we were in 2022. Hardest hit area, real estate. Home buyers needing to borrow to buy, face potential carrying costs more than double what prevailed at the start of the year. Auto industry also reeling right now as financing for vehicle purchases up substantially. Of course, the higher interest rates negatively affect businesses, and it hurts stock investors because it makes the bonds look more attractive with the higher rates. Federal Reserve to the rescue. Era of repressed rates came to a dramatic end as the Fed concluded actually it was behind the curve in halting rapidly increasing inflation. So on the right, you can see the stair-step higher federal funds rate set by the Fed. Now through the start of this month here in February, the Fed funds rate is approximately 4 3/4, up from just 0.8% about 13 months ago. Big adjustment, short period of time. On the left, you see the effect of withdrawing another key tool of monetary policy. So during the pandemic, and actually since the subprime crisis, central banks and our Federal Reserve have been forcing interest rates down to spur growth by basically buying up bonds and other credit instruments. You know, how do they do this? Basically, they just literally create money out of thin air, expand the assets on their balance sheets. But now, with inflation rearing its head, they're trying to reverse course, and you can see that on the chart on the left. So this gives you a visual look at how bad the stock market was in 2022, which is your last negative column on the right. S&P down nearly 20%, NASDAQ down almost 35%, Dow down about 5%. All sectors down except for energy, which had an eye-popping return of well over 30% last year. It's rare that only one sector has a positive return. Its return was due to the rise of oil and gas prices due to inflation, plus the Russia-Ukraine war. Of course, the sector was starting from a very low level due to its multi-year poor performance, plus concerns by many investors of its environmental effect. Utilities, consumer staples, just a little behind, seen as somewhat safe havens amid the volatile interest rate environment. Tech and its close kin communication services, think, Netflix and Facebook owner Meta platform, hit very hard, both due to their high valuations coming into the year, but also the effect that higher interest rates have on stocks whose earnings are very long dated. So this chart shows you the market performance over the last 42 years. It shows generally the market does well because you've got 32 of the last 42 years market up. It's rare for a negative year to be followed by another negative year. And that's, so that's one reason to be optimistic for this year. So virtually, this is the same chart, but focusing on fixed income, AKA bonds, over the last 42 years. You can see there was virtually the worst year on record for bonds. This goes back 46 years. Historically, with bonds, you've got a better chance of a positive return than with stocks. There's only 4 years out of the last 46 have you had a negative total return. Of course, 2022 wasn't just a negative return. It was actually the worst return the last 100 years. It punched a hole through traditional portfolio management, which posited that you have a balanced portfolio of stocks to take advantage of growth. And if growth or some other thing is making stocks progress difficult, the bonds will do well as money flows there. That did not happen last year. Russia-Ukraine war exacerbated the weakness in the global economy, particularly inflation. Commodity prices started soaring, particularly oil and gas. Of course, Russia's a big producer, and threats of cutting off Europe still continue here. Ukraine nicknamed the breadbasket of Europe, and so supplies of agricultural goods like wheat became scarcer. The challenge remains that this source of inflationary pressure is really immune to central bank policy. China, big problem for years now. Of course, former President Trump imposed tariffs on it in response to allegations of technology theft, export subsidies. Fast forward to COVID-19, in Western countries, and particularly the US, came out of the pandemic more quickly due to superior mRNA vaccines, plus a public policy that encouraged vaccination. Apparently, for political reasons, China has not adopted the Western vaccinations and has a much lower rate of vaccination generally. To stop the pandemic, China regularly shut down key areas of the economy, weakening supply chains in the global economy. So here we are in 2023, and despite all dire projections, we've rebounded dramatically this year. In January, NASDAQ up 11%, S&P over 6%, Dow advanced just under 3%. So what's done best so far? Well, each of these rows shows a different sector, but you've got the consumer discretionary, communications, real estate, and technology up between 15 and 9%. The weakest were the sectors that were actually seen as most defensive for a tough economy, like staples, healthcare, utilities, plus the big winner from last year, energy. Their returns range from energy up 2.7 to a drop of 2% for utilities and healthcare. So what's been the big winner just in this early year? Basically, whatever was most bombed out last year rebounded the most and at the top of the leaderboard. Finishing first in the month of January in the S&P 500 was media outfit Warner Brothers Discovery, up 56%, but hardly getting back to even after a disastrous 2022, down 60%. Tesla second best, up 41%, but only after a 65% collapse last year. Indeed, among the 20 best January performers, only 3 outperformed the tough 19% slide in the S&P last year. And only one, Nucor, a steel outfit, had a positive turn last year. So the quick reaction is that these stocks represent a snapback rebound as they got oversold in December due to tax loss selling. And then January included a lot of short covering by short sellers, plus a great deal of speculative frenzy that the market was in for a nice rebound in 23. So what's the market going to do for the whole year? Technicians and momentum players say we're set up well. We had a positive Santa rally. That's the day after Christmas through the first 2 days of the new year. We had a positive first week of January. Many believe that that single week will dictate the rest of the year. And then we had the so-called full positive return in January. And many people believe, and history proves it out, that if you have a positive January, the rest of the year tends to be positive. The only problem there is the last time the NASDAQ did as well as it did this past January was 2001. And then it proceeded to fall 29%. Of course, 9/11 did not help. So looking ahead, what are the key factors to look at here? Recession or no recession? Wither valuations on stocks, inflation, interest rates. Will the Fed continue to be a Grinch? Will high energy prices thwart the economy? So drilling down into the economy a little bit, just about everyone says we're going to be looking for slower growth. Some people say we could be in for a recession, and some people say it could be a hard recession. You know, we actually may be in a recession now. We don't really know until after the fact. It's typically considered to be 2 quarters of negative GDP growth. But guess what? We had 2 quarters of negative GDP growth in the first half of last year. But they declined to call it a recession for political reasons. No, because the unemployment rate was very low. So the best argument as to why we'll have a recession is that the Federal Reserve is determined to squash inflation, even has to raise interest rates very high to do that. And of course, high interest rates are a real negative to major sectors in that economy. However, inflation may already be coming down sufficiently to give the Fed pause. In any event, you know, recession does not mean we can't continue to play. It will cool inflation and may spur companies to become more efficient. I think it was Mark Zuckerberg the other day that said that in terms of meta platforms, formerly known as Facebook, this is the year of efficiency. Certainly, the blowout numbers we saw for January's job report on Friday, with over 517,000 jobs created and the jobless rate dropping to the lowest since 69, suggests recession is not, well, at least imminent. So I do believe stocks are going to continue to rebound in 2023. History's on my side. As we looked at before, 81% of the time, a negative year is followed by a positive year. Of course, that's not guaranteed. And in recent history that certainly all of us here in the room can remember, in the oil shock years of 73, 74, we had a couple down years in a row. The dot-com implosion gave us 3 down years in a row. And the subprime meltdown about 14 years ago saw 2 years down in a row. Some argue that the ultra low interest rates experienced until the start of last year, which created the crypto craze, the NFT nuttiness, the SPAC euphoria, may require a second down year to ultimately squeeze those excesses out. Of course, valuations are significantly lower than last year at this time, but certainly not cheap relative to history, nor cheap in light of the new higher interest rate regime. But certainly if you eliminate the mega cap tech stocks, the valuations look a little better. Unfortunately, with stocks' strong start in January, valuations are less attractive. Another wild card, of course, is corporate earnings. Currently, analysts forecast higher profits this year than last, but some say that can't be right. That's inconsistent with a weakening, if not recessionary economy. Stocks will come down, they say, when analysts get realistic, and that might be a buying opportunity. Something to watch, but I'm not sure you can time it. And of course, if you buy a stock with a 20 PE, you're effectively paying for profits over the next 80 quarters. So I wouldn't get too carried away if one quarter's profits are disappointing. What's going to happen with inflation this year? So many signs point to lessening inflation. You know, the CPI for December was a negative 1 month report, down 10 basis points. Of course, if you annualize that, you're going to have negative for the full 12 months. But, you know, we're going to need a lot more than a couple better months in terms of inflation to get comfortable that inflation's out of the system. The stickiest aspect is this inflation in wages. As they are starting to rise and typically don't reverse course, inflation could remain there. Remember, labor accounts for about more than half the price of goods and services. So stickiness or worse in wages could keep inflation high. So, you know, what does Wall Street really think is the long-term outlook for inflation? Well, one thing that's interesting to do is look at your yield on your TIPS. Those are the Treasury Inflation Protection Securities issued by the government, and you're finally getting a positive return of 1.2%. Then you look at the conventional 10-year Treasury at about 3.6, and you look at the difference. That shows you that Wall Street today thinks over the next 10 years, inflation is going to be the difference, about on average 2.2% a year. That's not the 2% target that the Fed wants, but something to keep in mind. So how about interest rates? So if you think forecasting the stock market is tough, try forecasting the bond market. The consensus seems to be that rates are going higher. However, based on history, that's actually unlikely because we saw this rare that there's a second down year in a row for the bond market. Financial theory suggests that the current interest rates reflect a consensus on the proper rate for the period of the bond in question. So for every seller out there of the 10-year Treasury at 3.6%, someone is buying it. So the good news is rates may not be going higher, but they may not be going lower either for those folks out there waiting for a better mortgage deal to buy their next property. So the big wild card this year may be the Fed. If the Fed pushes rates too high to squash inflation, it may throw that economy under the recession bus. The bullish case for the market is that the Fed sees us making progress against inflation. Certainly, Jerome Powell said that on Wednesday when he used the word disinflation many times in his presser after the announcement. That's why after 4 3/4 point hikes last year, we just saw a 50 basis point hike in December and just 25 announced February 1 here. The bulls argue that inflation declining, the Fed will acknowledge that, have perhaps just one more rate hike, and then even start cutting rates by the back half of this year. But the Fed's forecast is for up to 2 more hikes and not cut rates this year. The Fed's case, of course, is strengthened dramatically by the strong jobs report we saw on Friday. Energy. You can see it actually hit its high point last year in the beginning of the year, and it's kind of tailed off since then, dramatically lower on the chart on the right, which is natural gas. So it's a wild card. The bullish factors for energy in terms of higher prices would be a better economy here, going to use more energy, and a better economy in China. Negative factors, of course, would be the opposite. You know, for energy bulls out there have to realize that if for whatever reason, Russia and Ukraine can reach a resolution of the war, that's going to drop prices dramatically. But I still think longer term, legacy oil and gas may be going higher. Policymakers, investors are discouraging energy firms from exploring for more on environmental grounds. Plus, investors, for their part, are weary of poor returns in the oil patch. They're demanding that overexpansion stop, take the profits that are being made, return them to them in the form of dividends and stock buybacks. However, the lack of sufficient development for new resources may push prices higher because consumers and other users are not able to wean themselves off legacy oil and gas to operate their vehicles or heat their homes. I mean, just think for yourself, how many out there have as a 2023 resolution to switch to an EV car or to put solar panels on your roofs to heat your homes? So a couple of financial to-do lists I always like to start when we talk about what you should be doing going forward. Tax sheltered accounts, use them. Rebalance the portfolio. Look at a couple new tax rules. And finally, avoid low-yielding bank accounts. So on the tax sheltered accounts, I'm not going to tell you guys to fill up your 401ks and your IRAs because for the most part, you're out of the workforce. The thing I would urge you to take a look at is the 529s and to consider funding using 529s, your kids or perhaps more probably grandkids for their college education. Well, now, why would you do that? Because the money grows tax sheltered and then comes out tax free, which is better than a 401k or traditional IRA if used for higher education. You and your spouse can each make a non-reportable gift of $17,000 to each particular beneficiary. So you could put $34,000 into a 529 for each grandkid this year. Well, all these tax goodies are nice. What I really like about tax sheltered accounts is they're like roach motels. The money goes in and it doesn't come out because it's too complicated to figure out how to take it out. So it enhances discipline, which we all need. Consider also Roth conversions, which involve transferring money over from your IRA to your Roth. Why would you do that? Well, once it's been in the Roth for 5 years, all amounts come out tax-free, and there's no required distribution schedule. What's the rub? The rub is that whatever you convert is going to be taxed now. So it's probably best suited for someone who truly believes that tax rates later on, when they might be otherwise taken out from the IRA, is higher than the tax rate they're paying today. Even though bonds were poor performers last year, most likely your stock funds did worse. So those trends have reversed themselves a little bit in this early start of the year, but it's still probably a good time to take a look at that allocation in rebalance assuming you have an asset allocation, to rebalance in favor of stocks. That would mean moving some bond money over to stocks to take advantage of further gains. You know, there's a lot of people out there that have some cash, and they're always asking, is this the right time to invest? And I have to tell you, get on that today. Buy something, anything. Cash is your worst investment asset. Waiting for more clarity on the economy, inflation, or the Fed is a loser's game. By the time you figure it out, everyone else is already going to know it, and prices will reflect that. So the chart on the right shows the path of the markets with the green over the last 50 years. The red line below that is if you missed the 25 best days during a 50-year period. You don't want to be on the red line. And the problem is that no one knows what day will be the best day. So my general advice is you got to be in it to win it. There's some changes that were made in the tax law in connection with passing the budget right before Christmas. None are earth-shattering, but they're worth keeping in mind. Number one is that the year that you must start taking your MRDs from your IRAs has basically been pushed back 1 to 3 years if you haven't started already taking your MRDs. So it goes from the current 72 to perhaps 73 to 75. The other thing that's worth keeping in mind is that if you have a 29 for a kid or a grandkid, it hasn't been used, you can roll tax-free up to 35,000 of that into a Roth. Something to look at. It won't make a huge change in your life, but as opposed to bringing it out and paying taxes on it, that could be a good thing. So what investments am I recommending this year? Well, I like anything overseas. I like companies that pay dividends. Short-term debt can make a lot of sense in some circumstances. And finally, I know I don't have to remind this crowd, but stay away from the fads. We'll talk about a couple of those. So why international? Because, for years and years, overseas stocks have lagged domestic ones. Popular reasons given as to why that might be is, well, the real tech, the real drivers of the economy are in this country. Japan and Europe, just, they're bureaucratic messes. But, if you look at the chart on the right, you can see that the darker color is when U.S. domestic markets are doing better, but the lighter bluish colors shows when international markets are doing better. So, the baton does get passed back and forth. International and domestic, between international and domestic, and that there are long periods of outperformance before then reverting back. We may be at the cusp of one. And why is that? Interestingly, one thing that's not covered well by the media is, believe it or not, you could beat the market last year if you went abroad. What do I mean by that? So if you put your money in the Vanguard Total International Index Fund at the end of the year, you lost about 400 basis points, 4% less than if you put the money in the Vanguard S&P 500 Index Fund. That's not well known. It basically happened in Q4. And that trend has continued this year. So, for example, I was just looking, Fidelity's International Index Fund is up 8.2%. Its Emerging Market Index Fund is up 8.1%. The S&P 500 is only up 7.9%. One thing to note, however, smaller and mid-sized stocks here have really gotten off to a hot start. So the so-called Extended Market Fidelity Index Fund is up 13.7%. So is there any fundamental support for overseas stocks right now? And I think there are. The chart on the left shows the valuations of them using the so-called PE, price to earnings ratio. And you can see by how far down is the line on the right side of the left chart, you got a 30% discount on valuation of international stocks relative to domestic stocks. We have not seen that in the last 20 years. On the right, it shows the relative dividend yield on the overseas stocks versus domestic. And right now you're getting 1.6% more on the international index versus domestic. So that's almost twice the dividend yield on the domestic, which is about 1.7%. So I'm not suggesting you invest overseas just to capture that extra, 1.6% per year. What gets me a little bit more interested is if the levels of the indexes move up so that the disparity between the two yields approaches parity. Then you could be almost doubling your money. That's what could be interesting for me. So speaking of dividends, dividend stocks, in my view, are always a good bet. And you can see on this chart how over the long haul, over almost the last 100 years, how dividend paying stocks have outpaced non-dividend payers. With a dividend paying company, you have some evidence that you're dealing with a seasoned company. You've got some evidence that it's profitable. And you've got some evidence of the valuation simply by comparing the dividend yields. One thing that's interesting though is that there's really like two approaches on dividends. One is you put your money in the biggest, fattest dividend yields. And the other, you say, well, I'm not looking just for absolute dividend. I'm looking for the growth. And so an example of how this might work out is you could take the Vanguard High Dividend Yield ETF. Right now, it's offering a yield about 2.8%, which is much better than the S&P 1.7. And how did it do last year? It was almost at the flat line versus a big fat 19% loss. That's pretty attractive. And it saved people's you-know-what last year in a tough year in the markets. So as I mentioned, you could also look for companies that have experienced the best growth in the dividend payout. An example would be, and it's shown by the green line at the very top in this chart, the Vanguard Dividend Appreciation ETF, symbol VIG. Of course, you are going to give up on current dividend yield. That yield is just 1.8% versus the 2.8% on the fattest dividend payers. Still better than the S&P 500. Last year, it was down 10%, which isn't great, but still a lot better than that 19% drop in the S&P 500. So then the question is, what's the best for the long haul? Both of those funds were established by Vanguard in 2006, which is on the left. And you can see that there's been, the dividend grower has outperformed dramatically, on average, 2% per year better. So what's my advice? My advice is stick with dividend growers. But of course, at any given time, relative valuations and tactical positioning could cause you to be flexible in that. One thing that's interesting is that the pure S&P 500 did almost as well as the growing dividend thing. We'll see whether that continues. So is there a fun part to this talk? I'd like to go with the stocks. I generally prefer individual stocks versus mutual funds. Why is that? I can be more targeted with how I allocate capital. I avoid mutual fund fees. I've got more options as to how I handle my portfolio to minimize my tax bill. Hold on to winners, sell losers, you get it. As opposed to having everything in a big bundle where I have a decision to sell all or hold all. So here are 3 stocks that you could consider if you're looking to add large domestic dividend payers to your portfolio. So let's start with Pfizer. Pfizer, of course, is your quintessential blue chip with a focus on development and marketing of proprietary drugs. The company was arguably the star of the pandemic, as its vax was one of the key compounds that reduced the risk of COVID-19. The problem is it did so well, it's now having trouble explaining to investors what the encore is. The vax business, and indeed the Paxlovid business, a drug for use if you contract COVID, is starting to tail off as that pandemic passes and the US government stops subsidizing doses. The bullish case is a lot of that is now reflected in the stock price, as the stock is now down 30% off of its all-time high about 13 months ago. So its price decline, I believe, does give you a cushion if there's a big valley that takes time to cross for the next blockbuster. Your dividend, we talked about dividends, 3.7%, or more than double the overall market. Companies sure to earn more than $4 a share both this year and next. And in my world, that's not very demanding for a $44 stock. That gives it a PE valuation much below what it's normally had and below its peers and indeed the overall market. If you're worried about recession, Pfizer's not particularly sensitive to the strength of the economy. Stock is down 12% at the start of the year here. So if you're worried about overexuberance as we started 2023, this might be something to look at. It's volatility, which means how much it goes up and down relative to the overall market. With a beta of just 0.53, it's about half the volatility of the overall market. Pfizer, in my view, is as much of a marketing company as a research company and boasts one of the top sales forces in the world. We believe right now, one of the reasons Pfizer's down is reluctant to boast about its prowess. It's the politics of healthcare and the sensitivity of profiting off the pandemic are very sensitive issues. So I think they downplay it, but that could be an opportunity. Next one, this is a little more controversial here. 3M. You know, they're a dividend king. Does anyone know what a dividend king is? Oh, you've all heard of dividend aristocrats. That means a dividend aristocrat means the company has increased the dividend for 25 years in a row. So what's the dividend king? 50 years in a row, increasing that dividend. And at this point now, and that's 3M, at this point, it's the second highest dividend yielder on the Dow, just behind Verizon. The stock has lost 60% of its value in the last 5 years. So you're certainly not buying on a spike. So what gives? The concerns are myriad. Litigation, perceived deterioration in its R&D pipeline, strong dollar, which is a headwind when you're trying to be an exporter. Overseas economies have not been particularly strong, or falling organic sales, and they're have big exposure to China. So the perception is it's an old tech company with the best and brightest saying, I'm going to skip over Minneapolis. I'm going to go right to Silicon Valley if I'm interested in tech. But I personally don't think this company has lost it. It could be a good investment. I still think that 3M is an innovative powerhouse that can leverage its R&D platforms across multiple categories. Lots of consumer brands we know and love are examples of where 3M appears. You know, your Scotch tape, Scotch Guard, Post-its, Scotch Brite, Ace bandages. They have nearly 120,000 global patents. Recently, shares of the industrial conglomerate lost 6.2% to a new 52-week low after it said what it should be doing is cutting 2,500 manufacturing jobs. So, you know, what could be a positive catalyst? What turns it around? Well, they've got 4 distinct divisions. A weaker dollar seems to be up ahead. So I could see an activist coming up and saying, don't just cut 2,500 jobs, cut 25,000 jobs and start spinning off some of these divisions in an effort to create more shareholder value. And I think that people could make some money. And while you're waiting, enjoy the 5% plus dividend. Finally, Walgreen Boots. Now, okay, Walgreen Boots is a mere dividend aristocrat, not a king. So you only got 25 years in a row of dividend increases. And right now that dividend's at 5%, and the price to earnings ratio is well under 10. So Walgreens is basically a duopoly with CVS, with 13,000 stores. You know, 80% of Americans live within 5 miles of its store. It's got 29% of the domestic drug market. It's got a major equity stake in publicly traded AmerisourceBergen, a medical products wholesaler. It recently acquired our beloved, for many of you, I'm sure, Summit Health, also known as Summit Medical. So what's going to be the catalyst to get that going? Well, they bought Boots a few years ago, and the timing was poor because Europe has been under pressure since then. It's a UK drug vendor. If they could unload that, I think you'd have a much higher stock price. So, you know, for some people, they're going to shun the stock market and want to cash in on a very low risk investment. High quality investment grade corporate bonds now yield 5.4%. That's a whole different world than just last year at this time. You know, the other day I was watching TV and this pundit was very conservative in the outlook. And he said, hey, you know, the market's only going to give us about 5% this year. And the anchor turned around and said, well, why not just get a 5% corporate bond and skip the hassle, the volatility of the stock market? The guest was speechless. So, you know, it's a reasonable choice in this market just to go with a 5% plus yielding corporate bond with short maturity, particularly if your goals are shorter term and you're not in a super high tax bracket. Bads. You know, I have the cocktail party test. If I go to a gathering and everyone's telling me about investment, run for the hills from it. And if everyone is complaining about something, go home and do some research. So what are some areas to be cautious of? So right now, it's starting all over again. Remember, a generation ago, .com. All the companies were putting somehow .com after their names. It's starting now with AI and chatbot. I'm joking with my employer at Peapack. If we just call ourselves Peapack AI, the stock price is going to double before the end of the week. So That's obviously something that makes no sense whatsoever. Cryptos. I'm still not a crypto fan. I'm sorry. Bitcoin has lost more than half of its value, but maybe for good reason. I'm not seeing it as a store of value. I'm not seeing it as an inflation hedge. I'm not sure it serves any particular need other than to perhaps hide your activities to escape taxes. It pays no dividends. So I'm anti-crypto. Munis, I love saving taxes. The problem is that there's a lot of retail investors who are out of the market now, but want to get some more generous income. The problem is munis right now are trading at about only 60% of the yield on treasuries of the same maturity. That's historically low. And so before you buy your next muni, you might take a look at the yield on a treasury. Remember, you don't pay state tax on a treasury. So just look at the federal thing and say, times my marginal tax bracket, what we'll have left, and compare that with the muni you're being offered. And of course, the treasuries are more liquid and so forth. So just be a little cautious with the munis right now. Also, finally, defensive stocks. They haven't started the year off well. In most defensive stocks, we're talking staples, we're talking utilities. They're basically value stocks. Not a lot of growth, but the problem is they're trading at growth multiples. So many people are afraid of the recession. They're saying, I want to buy Clorox. I want to buy public service, electric and gas, that they're now trading at substantial valuation premiums to the overall market. So slow growing stock being traded at a sharp premium doesn't make a whole lot of sense in my view. And finally, just be cautious of some of the pandemic favorites. Some of these companies did very, very well, your Pelotons, your Zoom technologies and so forth to make our life easier. Indeed, almost all the large tech stocks. I mean, Amazon added 1 million workers in 1 year to handle the online purchasing demand and so forth. Not sure that as we continue to move away from the pandemic, that their businesses will still be under pressure and they're still perhaps trading at too high a multiple. So with that, I thank you for your attention, and I'd be delighted to take questions, comments.
Thanks for the very concise and important message. My question is, with the S&P 500, what do you think of that as a 10-year investment as opposed to individual stocks or other forms of investment?
Yeah, so that's a great question. Yeah, I guess I would say that over the next 10 years, I'm still bullish on stocks. And basically, you have to look at what your competition is. So, I mean, you got a 10-year treasury at 3.6%. So, I'm thinking that, even with elevated valuations and other headwinds that we see today and the others that we're not even thinking about that will happen over the next 10 years, I think you're going to do better with stocks. So I certainly would have at least half my portfolio in stocks. So now the question is, well, what stocks? Well, I made a pitch for international stocks. So, I could make a great case for, in the stock portion of the portfolio, don't focus all your money. There's 10,000 stocks out there and 500 in the S&P 500. So it seems to me if one of the most fundamental principles of diversification or of investing is diversification, focusing on just those 500 stocks is not optimal. So I think that, a real easy portfolio might be 1/3, 1/3, 1/3, which would be 1/3 S&P 500, 1/3 international index, 1/3 mid and small cap domestic index. One of your problems with the S&P 500, of course, is that it kind of takes investing 101 and turns on its head. Usually when a stock price goes down in value or is cheaper, you should get more interested. And when something goes up in value, you should be more cautious. That just makes sense, right? The S&P 500, of course, is not just 500 stocks thrown and shaken up and here you go. Rather, they are weighted according to their market cap. So the more valuable or expensive, or however you want to characterize it in the marketplace the stock is, the more weighting there is. And so it's come down a little bit, but recently the top 10 stocks in the S&P 500, close to 22% of the overall movement in the index. That's your Amazons and Netflixes and stuff like that. And so for that reason alone, it wouldn't be my favorite. If you like the top 500 stocks in the United States and say, I got to be there, I would probably be looking at the S&P 500 ETF that equal weights them. So you have all 500 stocks with the same amount allocated, because then you're going to have a little bit more exposure. Then you're not going to be emphasizing those that are higher in value and de-emphasizing those that come down in value.
Online, Rick Smith.
Yes, David, thanks for a fascinating discussion as always. Last year, I purchased a $10,000 U.S. Treasury I bond, and by the way, so did the Summit Old Guard. I'd like to know your thoughts, positive and negatives on the U.S. Treasury I bonds.
Well, certainly far better deal than they were 5 years ago, because of course, inflation is higher, maybe not on a net real thing. If the interest rate goes up, inflation rate goes up, you're, kind of not making any real progress, but I guess that's better certainly than a savings account. I guess there's a couple issues for me there. I don't own them. Okay. First, let's, $10,000. It's a rounding error. It's a gimmick. And one of the things about successfully managing your money as you get retirement is keep it simple and easy. And having a lot of different $10,000 accounts for everyone in your family is certainly inconsistent with that. Although someone did tell me 10,000 each year. So over the next 10 years, maybe you can get 100,000. Okay, great. Second, of course, is that I think if you don't hold it for 5 years, there is some sort of a penalty if you withdraw it. And so I'm saying, fixed income and bonds is for short-term volatility, dampening that, and for short-term needs. So, this is where people say, well, I want to get a 30-year muni. If you're willing to tie your money up for 30 years, go into the stocks. I think you're going to do better. So that's a drawback, the early withdrawal penalty over 5 years. And of course, you're locking in your rate for 6 months, and then it's going to readjust to the new inflation rate. If Jerome Powell and the Federal Reserve has his way, you're going to be rolling over into lower and lower rates. And finally, there is a tax aspect. I'm not the tax expert at the firm. However, and there could be an issue as to when you finally extract your money, but basically you're going to pay ordinary income tax on your profits, your interest, and you're going to do that within the next 5 years. That to me is not as good as buying a stock where I can get qualified dividends. It's going to be taxed at half the rate of ordinary income. Hopefully I get my long-term capital gains are going to be taxed at half the rate. And guess what? Everyone in this room, yours truly included, has to think about the next generation. And then under the craziness of our tax law is that if you're successful with a stock and you pass away holding it, no one pays any tax on that. The next generation is going to take it with a stepped up value. I don't know how that rule is going to last forever, but it's too complicated for most politicians to get into. So for my mind, it's not an optimal situation. Is it better than getting 0.01% at your local bank account? Yeah.
Thank you, David.
Question back here.
You mentioned avoiding pandemic stocks, but you mentioned Pfizer earlier. That's a good buy. You don't call Pfizer a pandemic stock?
Yeah, that's a good observation. It was a pandemic favorite. I guess I would submit that it has, with that 30% decline in the last 13 months, that a lot of the pandemic delight in it has been squeezed out. And of course, it's not a pandemic stock in the sense that some of these new tech companies, your Pelotons, your Zoom technologies, your DoorDash, things like that, where Pfizer has been around for decades and decades and decades. So although there's a little bit of that, I would submit it's in the price, and there's a reason to believe why they're going to have a good second act at some point. Yes, sir.
Here. Thanks a lot. I had a couple of questions about 529s, educational reimbursement funds. So Congress changed the law and those accounts can be now used for any education. Is that correct? Including high school, grade school?
Well, certainly for, it can be used for, private schools at the secondary level. I
Right.
think there's a cap. And I think I'm going to say it's 10,000 per year, which helps, but unfortunately, particularly in this area, is not going to cover all of it.
In addition, Congress has passed a law. The problem with 529s is that they are an orphan fund, and if you didn't use it, there was a penalty. They're now allowing you to transfer unused funds to perhaps Roth funds with a lifetime cap about $30,000. So if your kid doesn't go to school and you got all the money in there, there's a place for it to go where that wasn't the case before.
Yeah, it's a nice little goodie that was contained within the recent budget bill. Of course, you also have other options. You can transfer it from one grandkid to the other grandkid. One grandkid decides to go on to graduate school, needs the money. You could do that. You could transfer it back to yourself and go into New York and study at NYU, or, you know, so there's other ways to handle it.
Thank you, David. You pointed out how strong employment growth has been recently and the fact that the unemployment rate is at historical lows. At the same time, some firms that we typically think of as being very savvy, Meta, Alphabet, Microsoft, Salesforce.com, are beginning to lay off workers. Could they be the canaries in the coal mine?
You know, it's a great observation. Certainly it caught everyone on Wall Street off guard to see that huge job increase in January, because as you pointed out, I mean, I think Meta, Mark Zuckerberg's company, laid off 13% of the workforce. And there's been, you know, eye-popping job cuts at all the big tech stocks. So what would I say? I think just like many on Wall Street, they too got caught up in the pandemic frenzy that the whole world was going to technology. And of course, they had huge demand that they had to meet. You know, that's why Amazon hired so many people. And so now they're unwinding that. So I could say you could reconcile a generally strong employment mark with some awkward headlines by these tech companies by saying most of the economy, the pandemic was far from a spur to their business. It was a negative, but for the techs, it was a spur to their business. And now they're having to bring in their waistline a little bit. The rest of America is still getting back on its feet from the pandemic and still looking to hire. Found it was very difficult to hire before. Now they don't want to lose it, you know, start cutting people that they just recently got on board.
What do you think about Roth conversions?
So as a general proposition, I'm negative on them. And and here's why. I like to pay my bills later than sooner. That's just finance 101. You know, if you can defer paying, you can make money on the money you'd otherwise give to the government if you can hold on to it. But there are three situations where it still can make sense. One is if you are convinced that tax rates today are much less than what you're going to be paying 10, 15 years from now, you know, the terrible debt load that the government has, it's going to cause tax rates to go up, the states will follow suit, so forth, then it may make sense. The other thing that we're seeing for people in our vintage, perhaps, is the so-called valley. The valley is where someone retires before they have to start taking out from their 401k or IRA. So let's pretend, I think one gentleman talked about here, retiring at age 60, probably got a 401k IRA that started at age 72, and that may now be pushed back. It depends exactly when your birthday is to as far back as 75. So you may have a valley here between the high income years when you're working and the higher income years when you're forced to take money out of the IRA. This valley period could be an interesting time to reduce the balance in the IRA because you're at a lower tax rate right now than you're going to be once you turn 72 or similar and convert. So that's an idea. Finally, everyone in the room probably should do a $250 conversion. Now, why would you do that? Well, there's the 5-year rule that I alluded to, that you can't take advantage of taking the money out tax-free from a Roth until the account is aged for 5 years. A quirk in the law is that the 5 years starts when any amount is put into the account. So you can put $250 in today, and in 4 years and 11 months, move in 500,000. And then the next month, it's all blessed by the 5-year rule, even though only a little bit was in the account. So it's like a no-brainer to tell for everyone to start a little baby Roth, I call it. Yeah, it's a little bit of work, but at least you've got that 5-year time clock started. And maybe there's a situation where all of a sudden it makes sense to go big with the Roth, and you're ahead of the game.
Yes, thank you for the information. Question is that you mentioned a lot about Pfizer making money because of the vaccine and so on, but you didn't mention anything about Moderna. How did they do? Did they also benefit from this vaccine issues?
Yeah, so Moderna is an interesting speculation too, because it's in the same situation as Pfizer. Made a ton of money with their vax, which I was lucky enough to be able to take. And but I think the problem with the Moderna investment is that it's harder to articulate what's Act Two. Pfizer's got that sales force. They got a very robust R&D pipeline. Probably the biggest risk with Pfizer is they buy another company. And so if you really want to, make some money, try and figure out what's in Pfizer's line of fire, because then if they buy it, you'll get this, step up, and then you'll be part of the Pfizer family because they usually do stock for stock. But Moderna is harder to articulate what's the next act. They don't have the same type of sales force. What will they do once their profits in business in terms of the vax is completely gone? That's your homework if you want to do Moderna.
I want to follow up on the question about Roth conversions. Could you just, we're old people, and we're really, in many cases, we're investing for our descendants. Could you remind us, just at a high level, of what happens to Roths versus traditional IRAs in estates?
Absolutely. So your traditional IRA, you put money in, it may be tax deductible when going in. That's typically if it's in connection with your work, your 401k, or if you put a limited amount in outside of that, it's not deductible, but becomes a part of your basis. That's not probably all that relevant to what we're talking about. So the similarities between the two is the money they both grow tax sheltered. With the traditional IRA, at a certain age, you must start making withdrawals, and every dollar that comes out as a general proposition will go through the ordinary income tax filter, whether you take it out or the next generation takes it out. The Roth marinates in that tax shelter environment, and when you take it out or the next generation takes it out, it comes out tax-free. That's great. And there's no scheduled time to withdraw. So the Roth is a much superior vehicle. The problem is, how do you get the money in the Roth? If you're very low income, you can make limited amounts. If you're higher income, is the conversion where you're paying the tax now in exchange for the benefits later on. One particular strategy which we use in my family that may work for you is that you've got the next generation, and they're all, knowing the people in this room, they're all movers and shakers and paying tax at the highest rate and all that good stuff. While you, as a retiree, may be in a lower tax bracket. So one thing that's interesting as you get closer to the day we meet our maker is to convert your IRA into a Roth. Now, the bad news is you're paying taxes, but you're in the low tax bracket, right? If you don't do that, when the next generation takes it out, they're going to be in the high tax bracket. So do you see the game there? And then they can take it out tax-free. Someone's paid taxes, but it gets taxed at your lower rate as a senior citizen no longer working, and the next generation doesn't have to pay the taxes at their high rate. That's something to consider. We did it in my family. Obviously, a lot of considerations there.
Online,
Yeah, I have a question relating to the jobs report in January. The report was extremely high number, and I suspect that that's due to a quirk in the seasonal adjustment to the numbers. Normally in January, there's a lot of people who were hired in retail for the Christmas season who are unemployed. And I think that affects the number of that was reported of 500,000 plus new jobs. Do you have an opinion on that? Do you know how much the seasonal adjustment was?
Yeah. So I think that's a great observation, and it is a difficult time of year to estimate job growth because of the very seasonal factors you pointed out. Having said that, the amounts of jobs that are reported are always looked at against what's the consensus. So who creates the consensus? Full-time professional economists. So what we're talking about here in terms of the quirkiness of this period is not unknown to them. So you would think that if every year the same quirkiness develops, that would have been reflected in the economist's forecast, and the economist's forecast fell embarrassingly short. So it's a factor, but on balance, you're going to have to give credit to the fact that it was much stronger than expected. And indeed, a lot of strength there. Of course, it's just 1 month, and we'll see what happens.
David, thank you so much. What an extraordinary presentation. And think of how much we learned, aristocrats and king dividend players, baby Roths. And in answer to what Mark has to ask, what we might use as a strategy in terms of converting our traditional IRAs into Roth IRAs. David, as you know, from being here 3 times previously, we have 2 ways of thanking our speakers. The first is with a certificate of appreciation. And you'll recall, no doubt, that there's an orchid on that. And there's a very good reason for that, because back in 1930, when the Old Guard was founded, the city of Summit was at the epicenter of the nation's orchid growing and distribution industry. And so it was very natural for our founders to make that our logo. And then the second way that we have of thanking you is with the Old Guard salute.